Everything looks fine. Stocks are moving, indexes are near highs, news anchors sound confident, analysts are calm, and that should scare you. Because throughout history, the most damaging financial collapses did not arrive during panic, they arrived during comfort. Right before the fall, markets almost always look normal. No alarms, no chaos, no obvious warning signs, just business as usual. So here's the mystery. If nothing looks broken, why do the conditions resemble the moments before some of the worst financial disasters ever recorded? To understand why a normal market may actually signal danger, we need to rewind far before headlines, far before charts, to the systems and incentives that quietly shape modern finance, and once the pattern becomes clear, it becomes impossible to ignore. Financial markets were never designed to feel calm all the time in early market history. Volatility was expected. Prices moved sharply because information traveled slowly, risk was real, and consequences were immediate. When mistakes happened, they were punished quickly. Over time, governments, central banks, and institutions began chasing a new ideal: stability. Stability meant confidence. Confidence meant growth. Growth meant political and economic survival. So systems evolved to smooth volatility, soften downturns, and reassure investors. Interest rates became tools. Liquidity became policy, intervention became normal. By the late 20th century, markets were no longer just reflections of supply and demand. They became reflections of policy decisions. This shift introduced a subtle but critical change. Markets stopped correcting naturally and started waiting for rescue, and that is where the story truly begins. After major crises in the past, policymakers learned a dangerous lesson. Intervening early felt good. Each rescue reinforced the belief that downturns could be managed, delayed, or even prevented entirely. Interest rates were lowered to stimulate growth. Liquidity was injected to stabilize prices. Bailouts protected large institutions. Each action reduced short-term pain but increased long-term fragility. Risk no longer disappeared, it simply went underground. Debt quietly increased. Asset prices slowly inflated, speculation became normalized. And most importantly, people learned to trust that someone would step in if things went wrong. The system became dependent on calm as interventions worked again and again. A powerful belief spread through markets: bad things don't happen anymore. Volatility dropped, corrections became shallow, confidence turned into certainty. Investors stopped asking if assets were expensive and started asking how much higher they could go. Debt was no longer a warning sign, it became a strategy. Complex financial products multiplied, built on the assumption that prices would remain stable. Leverage increased because volatility looked dead. The appearance of normalcy became proof of safety. But under the surface, pressure was building. Every suppressed correction added weight. Every delayed downturn increased imbalance. Every rescue encouraged greater risk next time. The system was stable, but only because it was being held together. Every artificially calm system eventually faces a moment when control fails. The trigger is rarely obvious. Sometimes it starts with a small rate change. Sometimes a minor default. Sometimes a single institution breaking under pressure. At first, markets ignore it. They always do. Prices move slightly. Analysts dismiss concerns. Confidence remains intact. Then leverage begins to unwind. Forced selling accelerates losses. Liquidity dries up. Correlations rise suddenly. Everything that looked safe moves together. The calm shatters, not gradually but violently. What people mistake as a sudden crash is actually the release of pressure that built quietly for years. The shock is not the cause. It is the consequence. Once normal breaks, trust vanishes faster than capital. Institutions that looked strong reveal hidden weaknesses. Assets once considered safe lose. Buyers' interventions grow larger, faster, and more desperate. Emergency measures return: rate cuts, liquidity programs, guarantees, but each response works less effectively than the last. Why? Because confidence cannot be forced. When people realize stability was artificial, belief collapses. System becomes fragile not because of panic, but because assumptions were wrong, and the cost is not evenly distributed. Those closest to leverage suffer first. Those dependent on liquidity suffer next. Those least prepared suffer the most. After every crisis, the same playbook returns. More stimulus, more support, more intervention, short-term relief arrives, but the underlying problem remains untouched. the system becomes more complex, more indebted, and more sensitive to shocks. Fixes treat symptoms, not causes. Stability returns, but at a higher cost, and with less margin for error. Eventually, policymakers face a limit. They cannot print confidence. They cannot eliminate risk. They cannot permanently replace natural market correction. Normal becomes fragile today. Many indicators mirror past pre-crisis environments. Debt levels relative to economic output remain historically elevated. Asset prices have detached from long-term averages. Volatility remains compressed despite rising uncertainty. Markets appear calm while structural risks grow. What makes the situation more dangerous is familiarity. People have seen interventions work before they expect them again. They price them in. Which means when something finally breaks beyond control, the shock may be sharper, not because warnings were absent, but because they were ignored. The pattern repeats not because history is forgotten, but because it feels normal. So what does it all mean? Calm markets are not proof of safety. They often signal delayed risk. Intervention reduces short-term pain but increases long-term fragility. When overused, the most dangerous moments arrive when confidence feels justified and caution feels unnecessary. The warning is simple. When everything looks normal, ask why, because markets rarely break during chaos. They break after comfort, and the open question remains. If stability is being maintained rather than earned, what happens when the system can no longer hold itself together? That question is not about fear. It is about awareness. If you want deeper breakdowns of hidden financial patterns, systemic risks, and the signals most people miss, stay curious, stay critical, and subscribe for what comes next, because understanding the calm may matter more than surviving the storm.